Thank you, Renate. Thank you, everybody, for attending this event. So we've got a great panel today with Robert Sweeney, who is a senior economic policy analyst at TASC. His work centers on topic relates mainly to inequality, and has completed projects on a variety of topics, including income distribution, housing, care, corporate tax, and many more. Robert has a PhD in economics from the University of Leeds, in which he examined the growth of the financial sector in Europe. The discussion on this, so Rob will present the work that is focused on his brief launch today. We'll have then two discussants. So Paul Tang is a member of European Parliament for the Dutch Labour Party since July 2014 as part of the group of Socialists and Democrats. He entered the Parliament in the Dutch Parliament in 2007. Here he was the spokesperson for financial and fiscal affairs for 2007 until 2010, after the global financial crisis, right through the period after the financial crisis. In 2014, Paul Tang led the list of the Dutch Labour Party for European election. In 2019, he was re-elected. He mainly works on Economic and Financial Affairs Committee with a focus on fair taxation and sustainable finance and the role of data in our society. Since September of last year, he is the chair of the subcommittee on taxation. The last panelist is Dominik Bernhofer, who is the head of tax department at Arbeitskammer, a trade union think tank based in Vienna. Before that, he was a policy advisor to the Austrian government and worked on several tax reform, including the end of the Austrian market secrecy for tax purposes in 2016. I remind you, the audience, that you can write your question on the Q&A function, but also those that are following on other social media. We will monitor the questions that you write and we'll be asking them after the initial discussion. So without further ado, I give the floor to Rob for his initial presentation. Thank you, Rob.
Let me share my screen. Okay, I hope everyone can see that now. So the outline of today's presentation, I'm going to aim the presentation not only at experts in corporate tax, but also try to provide a high-level analysis for people who aren't necessarily up to date with developments in the field. So I'll discuss the broad policy context. I will discuss what I mean by formula apportionment, which might be one of the strategies that the European Union pursues perhaps next year after it implements its the recent global agreement. And particularly, I'll look at the impact of formula apportionment and CCCTB, which is the Common Consolidated Corporate Tax Base proposal. This is a proposal that was proposed a number of years ago, but it has been blocked. But the EU may try to pursue a version of this next year under the BEPID proposal, now that the UK in particular has left the European Union. So the context is, in today's world, taxing rights are allocated to jurisdictions based on a number of principles. One of those is separate accounting. And what that means is that subsidiaries of multinationals within jurisdictions are treated as separate entities, and a country has the right to tax a entity within its jurisdiction based on the profit that that entity makes, and it's without reference to, say, the global profits of the multinational. So what I mean by that, just to take an example, suppose Apple has a subsidiary in Ireland. Ireland is entitled to tax that subsidiary in its jurisdiction based on the profits that that subsidiary makes in Ireland. It has no reference to the global profits of Apple. Now, this creates a number of incentives for tax avoidance or profit shifting. Specifically, it incentivizes companies to overstate their profits in low tax jurisdictions, such as Ireland, Bermuda, Cyprus, and other ones, and to understate their profits in high tax jurisdictions, such as, say, the United States or France or something like that. And there's a number of means through which it does. So when, say, the parent company in the US is transacting with the subsidiary, let's say in Ireland, the parent company might transact on very favorable terms to the Irish subsidiary. And that boosts profits in Ireland, and it reduces profits in, say, the US, where the tax rate is higher, and obviously it's lower in Ireland, and therefore the company can reduce its tax bill that way. Now, in order to avoid that from happening, we have what's called the arm's length principle. So when the parent in the US transacts with the subsidiary, let's say in Ireland, it is supposed to do so at prices as if the Irish subsidiary were not within the multinational. It's supposed to treat that subsidiary on an arm's length basis, transact at prices, assuming that that entity is not actually part of Apple or whatever multinational that we're dealing with. And it is an imperfect system, and that there are very large estimations of the amount of profits that are shifted globally. Now, formula apportionment is quite a different principle. What it does is it looks at the profits generated by the multinational globally and allocates that profit to jurisdictions, or allocates the taxing rights to that profit based on some sort of a formula. One of them is revenue, and there are elements of formula apportionment in the recent OECD G7 agreement. So, for instance, if a multinational operates in two countries, but has all of its revenue in, say, country A, and has zero revenue in country B, well, then all of the taxing rights are deemed to be due in country A. So country A can tax all of the profits of that multinational at whatever taxation rate prevails in that country. That's even if, say, the company posted profits in country B and posted profits, maybe even lower profits in country A, because we're allocating now on a revenue basis. It just depends on where the revenue is generated. We can add more factors into that kind of formula. We could allocate taxing rights based on revenue and assets. So suppose we had the same situation as before, where basically all of the revenue is generated in country A and zero revenue is generated in country B. Basically, and now let's say we also have tangible assets in this formula. Suppose half of the tangible assets are in country A and half of the tangible assets are in country B. Well, then, because we're weighting revenue and assets equally in terms of how we apportion the taxing rights, country A would be entitled to tax 75% of the profits of that multinational, because all of the revenue is in country A and 50% of the assets are in country A as well. And then country B would only be entitled to 25% of the taxing rights, basically, because it has zero revenue and 50% of the assets. And you can add lots more factors into that formula. So the CCCTB, it weighs sales or revenue, assets, and labor market factors equally. And within labor market factors, this is the actual formula here. I really won't go into too much detail. But within labor market factors, the CCCTB, it weighs payroll and employees equally. So where the multinational locates its employees and where the multinational pays its payroll expenses, in conjunction with where the multinational has assets and where the multinational generates revenue. These are the factors which determine the right to tax the multinational's profits. Now, the OECD agreement, I'll just give very brief description of it. It allocates 25% of profits on a revenue basis, and this only applies to very large multinationals and profitable multinationals. So multinationals with revenue of 20 billion or more, and maybe 10 billion in the future, and multinationals with a large profit margin. 25% of those profits are allocated. The taxing rights are allocated on a revenue basis. That's pillar one. Pillar two of the agreement is a minimum effective taxation rate of 15%. And there are a number of carve-outs as well, which actually I won't go into, but maybe the discussants might talk about them as well. So what I did in the paper, I simulated what would be the effects of in terms of the corporate tax revenue on countries if the whole world moved towards formula apportionment, basically. So what this entry here, so if we just look at Austria here, suppose we allocated the taxing rights of multinationals on the basis of where the tangible assets are located. If that happened, well, then the tax intake of Austria the corporate tax intake of Austria would be 1.43 times its current tax intake. If we allocated taxing rights on a revenue basis, Austria's tax intake would increase by 37%. If it was based on the number of employees of multinationals, it would be 35% more. If we did it on a payroll basis, it would be a little bit lower. It would actually fall. And then what I did here was I looked at CCCTB1 and CCCTB2. So CCCTB1 is basically the European Union proposal. It includes payroll, essentially. It includes payroll, and then it excludes payroll, beg your pardon, and then CCCTB includes payroll, essentially. The reason why I excluded payroll in one of the calculations for the CCCTB is that the payroll data was much less reliable than the data on assets, revenue, and employees. These simulations were based on OECD country by country reporting, basically, which isn't perfect because it is macro level data, but it didn't have data on payroll, so that's why I excluded payroll and did separately CCCTB1 and CCCTB2, basically. So if we look at, say, the European Union, and we're looking at CCCTB1, basically we see that this is excluding payroll. We see that the tax intake for the European Union in aggregate increases, as it does for high income countries. It doesn't really change for upper middle income countries. It increases significantly for lower middle countries, and it also increases for low income countries. Then when we include payroll into that equation, we see that it also increases a little bit more for the EU, high income countries as well, and then it falls a little bit for developing countries. And again, when we look at just the categories and look at allocating on a single factor basis, we see that, say, if we were to allocate taxing rights on the basis of where multinational employees are based, we see that this here would be very beneficial for developing countries in particular. Lower middle income countries would increase their tax intake in aggregate by almost 100%. Allocating on a payroll basis is actually regressive, not surprisingly, because the high income countries can pay more. So a disproportionate amount of multinationals' payroll costs are located in the high income countries. So the European Union and high income countries would gain, and developing countries would lose. Again, with revenue as well, we see that developing countries actually lose. But when we look at, say, CCCTB, we see that the European Union does actually gain in aggregate, but actually several countries actually lose. Now the biggest losers are countries like Ireland, Cyprus also loses a lot, Malta loses a lot as well. The Netherlands surprisingly doesn't lose that much, and also surprisingly Luxembourg actually gains. Apparently multinationals have very high amounts of tangible assets in Luxembourg, and even though if we were to allocate on the basis of other factors, it would lose a lot. But when you combine that, the gain, when you combine those other factors with assets, there is actually gains for Luxembourg. But importantly, many countries would lose. So next slide. This here looks at CCCTB, but also combining CCCTB with, first of all, a minimum effective rate of taxation of 15%, and also a minimum effective taxation rate of 25%. And we see that, and this is with payroll, basically. We see that as we move from just CCCTB to CCCTB with 15%, there is an increase in tax revenues, but it's not that big, because most countries in the European Union actually have taxation rates in excess of 15%, basically. But there are significant gains in taxation revenues if we combine CCCTB with a minimum effective taxation rate of 25%. And we see that there's also gains for developing countries as well. Now, I looked at in that study, assuming that the whole world moves towards formula apportionment. Now, I did that because I wanted to see what the effects on developing countries are, especially in light of the recent agreement, which allocates some taxing rights on a revenue basis. But very likely, if the EU were to try to implement this again, it would probably just look at allocating profits generated in the European Union. So here, here I compare basically how countries would fare in terms of if global profits were apportioned on CCCTB basis versus only European profits. So Hungary is here. That means that Hungary loses the most in terms of its current tax revenue, both when we apportion global profits on a CCCTB basis, and also when we only apportion profits generated in the EU on a CCCTB basis. But generally, and then it's Cyprus, then Ireland, and the fact that, so this is basically the ranking of the countries. So number one means that Hungary loses the most, basically. And this here means that Croatia actually gains the most, Estonia as well, Belgium. But the fact that this is almost a straight line means that the findings can be generalized to if only we allocated EU profits on a formula basis. So what I would conclude from that is formula apportionment a la CCCTB, or some version of it, is sensible if it's accompanied by a minimum rate of 25%. Now, the current agreement, which allocates some taxing rights on a revenue basis, is regressive based on my findings. For developing countries, if we are going to allocate on a formula basis, it would be better for a CCCTB, but excluding payroll as well. I would like to see a minimum effective rate of 25%. Thank you.
Thank you, Rob, for your great presentation. It shows how international tax rules have these important distribution implications, and they should be measured against those distribution implications. They reflect a political compromise between countries, but that political compromise reflects the power relations between countries. So I'd like to give the floor now to Paul for his initial insight into this presentation. Thank you, Paul.
Thank you, and thank you, Robert, very much for this presentation. It's very interesting to see. I've been working on the CCCTB since 2016, when I was together with Alan, I was a rapporteur on that file. And one of the difficulties we had then is that we didn't have good data on what the consequences were for the different countries and member states. We were flying, say, in the dark. So the idea was put forward. We embraced the idea in the European Parliament, went to the capitals, and parliaments to discuss and promote this idea. But one problem we always had is that data were lacking on what were the consequences. And imagine a Minister of Finance in saying, okay, what is the consequence for me? You need to know what the impact, the budgetary impact alone will be. So it's very good. I understand that the new data are still not perfect, but it's certainly in a way forward. And I still think the idea of the CCTB holds much value. And the reason is that it will end forms of tax competition that we see now, the profit shifting that you started with. But it will also help to simplify the entire industry. Now we have a huge industry of tax advisors, accountants, and lawyers, all working at avoiding taxes. A system of apportionment is relatively simple and straightforward. Of course, getting there is not simple and straightforward, but the system itself is very simple and straightforward. Very much like the idea, and it will return because the Commission had to withdraw the CCTB proposal, since in the OECD there's a discussion on the tax base. We need to align the tax base in the OECD and the EU, but the Commission didn't give up on this idea and will come back with now BFIT, which is much easier to pronounce than CCCTB. So that's the one advantage we got. Two questions I still have for you. First of all, well, because what I find difficult still in the OECD agreement, but also in the CCTB proposal or the BFIT proposal, is what are the behavioral responses, right? So this is taking all as it is, or what do you expect will occur once you introduce this? I know this is a tough question, but it is bugging me that we take a static situation without taking into account behavioral responses. A second question is, in the European Parliament, we also amended the apportionment rule to include digital activities. And the reason for that is what we now see is that still the 5 largest corporations in the world are American big tech that provide many services for free, but generate huge profits through advertising. So what we try to do in the European Parliament is to make sure that the apportionment formula also included digital activities. We then used metrics that were provided to us by the OECD to capture this situation. But I still think the situation hasn't really much changed. If you look at Pillar 1 of the OECD, it's not directed at the GAFAs. It's the 100 largest multinationals, but it's not directed at GAFA, even though Bruno Le Maire very much wanted from the start to go after to have this sort of cover tax. So we're still in the situation that we have the largest corporates in the world, highly profitable and still relatively untaxed. Is that a situation you could also tackle with the CCTB? At least that's what we try to do in the European Parliament. I'm happy to hear your views. And then as a final remark, I think it makes a crucial difference, in my mind at least, if you have a European-wide system or you have a global system, right? Because I talked with some researchers who were like the idea of formula apportionment, or were skeptic that Europe could do it on its own if you would still be able to shift profits outside the EU. So I think that's a condition that you would like to have, is that you either have a European-wide system and including a withholding tax. Currently, the FISC subcommittee is discussing this week. We have a hearing on Wednesday on the withholding tax. So it's the combination of a CCTB and a withholding tax to make sure that profits don't go outside Europe, or that you have a form of global apportionment in which there's no the profit shifting ends. But I'm happy to see to conclude, Tommaso, to see that the idea of CCTB is still alive. It's worth fighting for, and the discussion will continue. Thank you.
Thank you, Paul. If I can just follow up with one question. You said, this is a proposal, the CCTB, that's been stuck at the EU Council, perhaps from the late 90s. Now the EU Commission is planning to put forward a new proposal with a slicker name in 2023. Do you think what is required for the stars to align? Will the minimum tax implemented in the EU, strong minimum tax, help those discussions?
The answer is probably yes and no. Yes, in the sense that I think with the minimum effective tax rates, the incentive to shift profits will be less, so we can have an EU-wide system and not having taxes shift abroad. But I think also the reaction will be that the reaction we saw after the first round of BEPS. The direction was to hold on, let's see what the consequences are of BEPS 1. And I would think we will have a similar reaction also to BEPS 2. Let's first introduce the minimum effective tax rate before we enter a new round of reforms. So that is yes or no. I think the good thing is now that we need to work to a common tax base, because if you want to define an effective tax rate, you need to define the tax base. So that's the good start. That's the good point. I also think that the Commission is taking a different approach. In 2016, it was a Brussels-based initiative, which I don't think is a very good idea. So it was cooked up in the Commission and they came out. The Commission tried to reverse the situation and go into discussions with the member states before introducing the proposal. And I think that's a method that might be well worth, that may well pay off, because start with building a coalition of countries. But I also learned that much depends on one city. When I remember when Alain Lamassoure and I were in Berlin, and we were, a bit shocked by the then conservative approach in Berlin. And whereas I assumed always that a country like Germany, with a relatively high tax rate, which is prone to base erosion, would be in favor. So I think now is also an opportunity to promote the idea of a CCTB or /BFIT, but to very much to promote it in Berlin. We have coalition negotiations ongoing. Well, any one of you out there, take your chance and make sure that's in the coalition text, right? So that would be a great help.
Thank you. Thank you very much, Paul. Dominik, now I would like you to provide your insight into Rob's initial presentation.
Yeah, thank you very much. And thank you very much for the presentation. Robert, I think this paper is very important, timely contribution to the discussion about the reform of international corporate taxation, with many implications also to go beyond the international agreement we've seen to go beyond in the EU. Yeah, I can only touch some of the implications and add on to something, to many points Paul Tang already mentioned. I think a very important point the paper makes is that there are important distributional implications of the concrete design of the apportionment formula. Your calculations show that revenues act regressive, are a disadvantage for developing economies, also in the EU, which is of course important in itself, but also from a political perspective important and needs to be highlighted. On the other hand side, I also want to mention the advantages of revenues as an apportionment factor. I think a first advantage is that revenues, if correctly sourced, are highly immobile. Customer sales revenues are highly immobile as compared to other apportionment factors like real assets, employment, and therefore set no incentives, no further incentives for tax competition, which is an important point, I think. And the second advantage of revenues is that they capture digital business models without further modifications, like the digital permanent establishment in the CCCTB that Paul Tang already mentioned, or similar features, which is also, of course, the main reason for the Pillar 1 reallocation to be based on revenues. So I think if we discuss the concrete design of a formula apportionment system in the EU, we need to take these pros and cons of revenues into account. What I very much like in the paper is the discussed option to combine formula apportionment and minimum taxation. I think, yeah, similar to what Paul Tang said, the minimum tax directive that the European Commission is planning to propose before the end of the year will entail many important preconditions for formula apportionment in the EU. Most notably, of course, the common tax base, but also the minimum tax in itself is, I think, an indispensable feature of a functioning unitary taxation system, because it helps against tax competition, which could even increase in a formula apportionment system. And it also helps against the so-called border's edge problem that Paul Tang already also mentioned, the fact that the CCCTB or BFIT at the EU level stops at EU borders and is, of course, then affected by profit shifting out of the EU, and a global minimum tax, of course, helps here. If a 25% minimum tax, as discussed in the paper, helps to facilitate a political agreement in the EU on formula apportionment, I think it remains to be seen. Of course, extra revenues can reduce losses in some countries, but I think also your calculations show that the countries most negatively affected by the CCCTB are EU tax havens like Ireland and Hungary, who have also been vocal skeptics and critics of a global minimum tax. And yeah, this, I think, remains to be seen. But nevertheless, I think a higher minimum tax rate than 15% now agreed at the global level is, I think, desirable in itself. And this is why it is important to insist, especially from a progressive perspective, to insist on a minimum tax directive that allows member states enough flexibility to get to a higher minimum tax rate, at least in the medium term. I think in the short run, the international agreement will be the lowest common denominator, but after a few years, member states could or should be able to opt out and go beyond the international agreement and go beyond the 15%. This could be a compromise, and if no such compromise is possible, I think willing member states that are willing to go beyond the international agreement should probably seek alternatives to unanimity, like enhanced cooperation or unilateral implementation to keep as much flexibility as possible. Because imagine a scenario where there is a European, a EU-wide minimum tax directive based on unanimity without such flexibility. This would lock in the international agreement for decades. Like the Irish finance minister said, it's 15%. 15% is 15% for his lifetime. With the EU stuck as a bloc, I think also improvements at the international level will get more difficult. And so I think flexibility when it comes to the minimum tax directive is key, and also important precondition for the chances to introduce formula apportionment at the EU level.
Thank you, Dominik. I'd like to ask you just a question going back on the different factors in the formula. So what is your assessment on how including factors like asset and employment might drive tax competition between countries in a balanced formula that can include a mix of factors? So what is your assessment of how you balance the risk of tax competition with the need for an equitable formula?
Yeah, this is an excellent question. I mean, in a formula apportionment environment, the effective tax rate of a corporate is in a way a formula weighted average of national rates. And if it's possible in such a system to reduce the formula weighted average rate by moving jobs to a low tax jurisdiction, this of course creates an incentive to do so. And in the US, where we have a formula apportionment system in corporate taxation for decades, many states switched to a sales-only apportionment system to remove such incentives. At the other hand side, of course, unions support the principle that profits should be taxed where value is created, and labor clearly has its role here. So to me, I think a balanced approach like the original CCCTB formula is still the best way forward here.
And what's your sense on Paul's question around users and how users generate value, and whether they should be reflected in the formula?
I think it's a good point. However, I think the question is if we just reallocate profits within the EU that are generated within the EU, or if we reallocate profits at the global level. Because if we just, I think, reallocate profits within the EU, the US is likely to accept such a reallocation, but at the global level, I think we've seen the complications, and I think such a reallocation would maybe, or I think it will be in conflict with the international agreement.
Thank you, Dominik. Before I give back the floor to Rob, I'd like to remind the audience that you can write a question on the Q&A function. If you're different social media, write a question on the chat on Facebook, and we're monitoring that, and we'll ask the questions after Rob's addressing of Paul and Dominik points. Rob, the floor is yours.
Thanks, Tommaso. Just in terms of the behavioral responses, I guess, Dominik, the question was posed by Paul, but both Paul and Dominik actually alluded to it to a certain extent. Obviously, if you don't combine CCCTB with any increase in taxation rates, well, then the incentive will be for multinationals to locate the factors that are in the formula to low tax jurisdictions. So presumably things like assets, employees, and payroll costs will migrate to countries such as Ireland, Hungary, Cyprus, and so on. Now, this can be mitigated somewhat if we combine the CCCTB or whatever formula apportionment system that we actually choose to pursue with minimum effective taxation rates, so that there are smaller differences in the rates of taxation between different countries. Because obviously, relocating your plants, your employees, and so on, has certain costs for companies. And if there are only small tax savings that result from that, because differences in taxation aren't large, well, then that obviously reduces the incentive to do so. In terms of the advantages of sales, yes, undoubtedly, sales or revenue is less mobile. I'm not sure if it's completely immobile as well, because there might be incentives depending on how the rule is actually implemented. There might be incentives to, say, channel your sales through some low tax jurisdiction, for instance, artificially selling your goods or services to some entity in some jurisdiction. But granted, it would be less than, there would be less scope for reallocating revenue or sales compared to the other factors such as assets, labor, and so on. I do think it is important to look at what the specifics of allocating on a revenue or sales basis looks like. So in my simulation, I use the CCCTB data, and that contains data on multinationals' revenue in different multinationals' revenue in the different countries that it does activity. Basically, it's the revenue of the subsidiaries. But there is a distinction to be made between revenue and sales. So my understanding of the recent OECD agreement is, well, it's yet to be decided exactly what a revenue basis will look like. But it looks like it's going to be, sales of goods and services to the final consumers. And that's slightly different, and that would offer less scope for gaming the system than just looking at the revenues generated by the subsidiaries, partly because revenue also includes things like interest income, income that doesn't just arise from the actual operating activities of the multinational. There was a couple of comments as well on the tax base. I didn't really look at that in the paper, and there would obviously have to be agreement on a common tax base in order for that to be implemented across the European Union. And countries have different rules on what kind of expenses they allow to be deducted, specifically with regards to depreciation of capital goods and how quickly or not they can depreciate. So that could be difficult to get. Well, presumably there would be agreement on it eventually, but it could offer difficulties. Now, just one proposal that I had seen, which kind of eliminates that, and I didn't really talk about it in the paper, would be to tax the change in the share price of a multinational. So so that would do away for because obviously if you're going to tax the profit, it requires some common definition of what the profit is, and that requires some agreement on what expenses are allowed to be deducted. But the share price of the company, well, that's just the share price. That doesn't change from country to country. So one way of getting around that would be to tax the change in the share price. So if the share price increases, you tax on that basis. Now, it's not something I talked about in the paper, but it's something to think about if it's difficult to agree on a common tax base.
Thank you, Robert. And we've seen from the US politics that taxes that were unthinkable until a few weeks ago, they might become reality in the coming days. We don't seem to have any questions from the audience, but so I'd like, given that the next panel starts in 6 minutes, I'd like to ask Paul and Dominik very briefly a question on where we are with tax justice. I mean, this has been a long and treacherous road. Where are we at the moment, and are you optimistic for the future? Paul first, and then Dominik.
I'm always optimistic, Thomas. So that's part of my job description. Otherwise, I can't be a member of parliament. So that's let's face it. About a year ago, we were still eagerly watching the presidential election, and we didn't think that we could have an agreement at the OECD level very soon. And it was probably, if anything, as I remember Bruno Le Maire indicated, was at best it was a minimum of 12.5%. That was not long ago. So yes, we can make changes, and we still need to make changes. I think that the OECD agreement is a great step forward, but we need a difference. We need to have successive rounds of these OECD deals. So it's not cut in stone. No, it needs, this is the second round. We need a third round for the OECD framework, and we need to push for that. And coming back to your question is, what are the possibilities of CCTB or BFIT in Europe? I also see that there is some, you could say, fatigue or acceptance by the corporates that they are in a discussion they are not going to win. So they are bogged down in a discussion of tax avoidance, which they would like to avoid. And for example, in the Netherlands, to my surprise, the employer organization that was dead against the CCTB in 2016 has changed its position and say, okay, we embrace it, because they want to get rid of this discussion of tax avoidance. So yes, I think there's still a lot of progress to be made. We need a higher rate than 15%, for example. We don't want the carve-outs that was dealt. We don't want to have the exception for the financial sector in Pillar 1. A lot of do we wish for, but yeah, I think we still have the momentum for change. And in that sense, I remain optimistic. One upcoming fight we will have in the European Parliament, though, is that in the OECD agreement, of course, the digital service tax has been ruled out. And it also seems to include the digital levy, which was one of the own resources. So we're into the next fight. The Socialists and Democrats is very much pushing now for a single market levy, which introduces the benefit principle for big corporates. So that when the Commission introduces the directive on the minimum effective tax rate, we also hope it will come forward with a new proposal for our own resources, because that's what we need to repay the recovery funds and to make the democracy in Europe more grown up, so to say.
Thank you very much, Paul. Thank you very much for your insight today. Dominik, we've got just a question from the audience in the last minute, and is the question from Katerina Berardi asking if the recent comment by Joseph Stiglitz, which is one of our ICRICT commissioner, claiming that the OECD global minimum tax of 15%, there's a risk they will become the de facto maximum over time. We've seen that in Austria is planning to cut the corporation tax rate. What's your feeling on, is this setting a minimum, or is it setting a kind of a future maximum?
Yeah, I mean, this is a very important but also very difficult question. I think from a simple economic perspective, I mean, the minimum tax will induce tax increases in low tax jurisdictions and lower tax differentials between countries. So there should be less incentive or low incentive to reduce taxes in normal tax jurisdictions. So there should be a positive effect, a lowering effect on tax competition. But of course, I mean, there's also a political discussion about corporate taxation, and conservatives and employers, also in Austria, use the minimum tax in a way to legitimize lowering a corporate tax rate. So there could be, of course, also a kind of legitimacy channel in tax competition that we will see after the introduction of the corporate tax of the minimum corporate tax rate. But this is, at least to my mind, still to be seen what the effect on tax competition will be in the end.
Can I just shortly also,
Yeah, of
because
course,
I think this is a very relevant question. This is the behavioral response, and we don't know for sure, of course. But usually when you look at federal tax system, you see a range of tax rates, where the larger countries have higher tax rates than the smaller jurisdictions. If you first take a look at Switzerland, Basel and Zurich have the highest tax rate, and of course there's always the outlier, and in this case of Switzerland that is Zug with the lowest tax rate. I don't see any reason why that would disappear. And the reason why Biden and the government put so much energy in the OECD proposal was to raise the corporate tax rate. So I still hope and think that it will be an increase for at least the largest member states, so that we also see an increase in the maximum. But if not, in the end, it's an empirical question, so we have to wait. In that sense, you have to wait and see, and in the meantime, of course, push for higher tax rates.
Thank you very much, Paul. Thank you very much for all the speakers. Just a reminder that the next panel will start in a couple of minutes. It will be chaired by Raphael Wildauer, and the panel is about fiscally sustainable public investment for climate, how to. So thank you very much for your time today. It's been great having you. The event will be is recorded, and so it will be available shortly after today. Thank you very much, and goodbye.